The 7-day beginner investing plan. What if I told you that 7 days from now, well, you could understand more about investing than most people who have been saying they'll start someday for years? Not because you'll become a stock market expert, not because you will discover a secret strategy, but because you'll finally have a simple plan. Today, I'm going to walk you through a 7-day beginner investing plan designed for complete beginners in the United States. No confusing jargon, no risky trading strategies, no promises of overnight wealth. Just 7 simple steps that can help you build confidence and take your first step toward long-term investing. By the end of this video, you'll know exactly what to do next. Let's begin. Day 1 must understand your money. Before buying a single investment, you need to answer one question. Where is your money going? Most beginners skip this step. They open an investment app, buy something they barely understand, and hope for the best. But successful investing starts long before you purchase your first stock or fund. It starts with understanding your cash flow. Imagine two people. X earns $4,500 a month but spends almost every dollar. Jordan earns $3,500 a month but consistently saves $400 every month. Who has a stronger foundation for investing? It's Jordan. Not because Jordan earns more, but because Jordan has built the habit of keeping some money available to invest. That's why your first task today is simple. Write down your monthly income, your monthly expenses, your debt payments, your monthly savings. Don't guess. Use your bank statements if you can. Small subscriptions, food delivery, impulse purchases, they add up faster than most people realize. Your goal isn't to be perfect. Your goal is to find an amount you can invest consistently. Even if it's only $25 or $50 a month, consistency matters far more than trying to start with a huge amount. Here's something many beginners don't realize. Trying to invest money you actually need next month often leads to panic. When an unexpected bill shows up, people feel forced to sell their investments at the worst possible time. That's why today's lesson isn't really about numbers. It's about building a foundation you can stick with. Because investing isn't a sprint. It's a long journey, and every strong journey starts with solid ground. But before you invest a single dollar, there's one financial safety net you should build first. Day 2, build your safety net. Imagine driving across the country without a spare tire. Could you make it? Maybe. But one flat tire could ruin the entire trip. Investing works the same way. Life happens, cars break down, medical bills appear, jobs change. Unexpected expenses arrive without warning. If every emergency forces you to sell your investments, you'll struggle to stay invested long enough to benefit from long-term growth. That's why experienced investors often recommend building an emergency fund before taking on significant investment risk. For many beginners, even saving enough to cover a few weeks of essential expenses can make a meaningful difference while you continue building toward a larger emergency fund over time. The exact amount that's right for you depends on your situation, job stability, and financial obligations. The important part is having a plan, not trying to reach a perfect number overnight. Think of your emergency fund as a financial shock absorber. When life throws you a surprise, it helps absorb the impact so your long-term investment plan can stay on track. Today's assignment is simple. Open a dedicated savings account if you don't already have one. Set a realistic savings goal. Automate a small transfer each payday if possible. Remember, the habit matters more than the size of the first deposit. Every dollar you set aside strengthens your financial foundation. And once you've started building that safety net, you're ready for the next step. Tomorrow, we'll finally answer the question, that confuses almost every beginner. What's the difference between stocks, bonds, ETFs, and mutual funds? And which one should you actually choose first? Trust me, once you understand that, investing becomes much less intimidating. By now, you've built the foundation. You know how much you can realistically invest. You've started building your financial safety net. Now comes the part that scares most beginners, actually choosing an investment. But here's the good news. Once you understand four simple investment types, nearly everything else starts to make sense. Let's break them down one by one. Day 3. Learn the four building blocks of investing. Imagine investing is like building a house. You wouldn't start with the roof. You'd start with strong building materials. These four investment types are those materials. Stocks. When you buy a stock, you're purchasing a small ownership stake in a company. If that company grows over time, the value of your investment may grow too. Some companies also pay dividends, which are payments made to shareholders from company profits. But remember, stock prices can go up and down, sometimes dramatically. That's completely normal. Short-term movement doesn't necessarily tell you whether a company is a good long-term investment. Bonds. Think of bonds differently. Instead of owning part of a company, you're generally lending money to a government or business in exchange for interest payments and the return of your principal when the bond matures, subject to the issuer's ability to pay. Bonds have different risks depending on the issuer and other factors, and their prices can also fluctuate. Many investors use them to help balance a portfolio. ETFs. Now here's where many beginners breathe a sigh of relief. Instead of trying to choose one winning company, an exchange-traded fund, commonly called an ETF, can hold dozens, hundreds, or even thousands of investments in one package. Imagine buying one basket instead of one apple. If one apple has a bad day, the whole basket isn't ruined. That's diversification. Mutual funds. Mutual funds are also diversified investment funds. Like ETFs, they can contain many different investments. The main differences often involve how they're bought and sold, how they're priced, and sometimes their costs or minimum investment requirements. For many long-term investors, either can be appropriate depending on their goals and the specific fund. Today's assignment isn't to buy anything. It's simply to understand these four building blocks. Because confident investors don't invest in things they don't understand. But even the best investment isn't helpful if you use the wrong platform. Day 4, choose a trustworthy investment platform. One of the biggest mistakes beginners make isn't choosing the wrong investment, it's choosing the wrong place to invest. You've probably seen flashy ads promising unbelievable returns. If something sounds too good to be true, it usually deserves extra skepticism. Instead, look for an investment platform that puts transparency first. Here are 4 things to check. Number 1, make sure the firm is properly regulated in the country where it operates. Number 2, understand the fees. Even small annual fees can reduce your long-term returns over decades. Number 3, choose a platform with an interface you understand. If using it feels confusing every time you log in, you're less likely to stick with your plan. Number 4, look for educational tools that help you keep learning. The best investors never stop learning. Remember, a good investment platform isn't exciting. It's reliable. Think of it like choosing a strong bridge. You simply want it to help you reach your destination safely. Now that you've chosen where you'll invest, it's finally time to decide what your first investment could look like. If you are getting value from this video, give it a thumbs up, like, share, and subscribe to my channel. Let's continue. Day 5. Don't chase winners. Start with diversification. Here's the question almost every beginner asks. What stock should I buy first? It's understandable. The media loves talking about the next big winner. But many experienced long-term investors focus less on finding one perfect stock and more on building a diversified portfolio. Diversification means spreading your investments rather than relying on a single company or sector. That way, if one investment performs poorly, your entire portfolio isn't dependent on it. For many beginners, broad diversified funds, such as certain ETFs or mutual funds, can be one way to gain exposure to many companies through a single investment. The right choice depends on your goals, risk tolerance, and circumstances. The key lesson today is simple. Don't feel pressured to chase headlines or the latest trend. Build a plan you understand and can stick with over time. By the end of day 5, you now understand the core investment types. You know what to look for in a trustworthy investment platform. And you've learned why diversification matters. Tomorrow, we'll make investing easier than ever by putting your plan on autopilot, so your future self keeps investing even when life gets busy. Day 6, put your investing on autopilot. You've built your financial foundation. You've learned the basics. You've chosen a trustworthy platform. You've decided what type of investment fits your long-term plan. Now it's time to make investing effortless. Here's a surprising truth. Most successful investors don't rely on motivation. They rely on systems. Think about brushing your teeth. You don't wake up every morning and debate whether you should do it. It's a habit. Investing should become the same. That's why many long-term investors automate their contributions. Instead of trying to remember each month, they schedule a recurring investment, whether it's $25, $50, or $200. The amount matters less than the consistency. Automation also helps to reduce one of the biggest emotional traps in investing: trying to guess the perfect time to buy. No one can consistently predict every market movement. Instead of waiting for the perfect moment, your plan keeps moving forward, month after month, year after year. This disciplined approach is often called dollar cost averaging, where you invest a fixed amount on a regular schedule regardless of market conditions. While it doesn't guarantee profits or protect against losses, it can help some investors avoid making decisions based purely on short-term emotions. The goal isn't to be perfect. The goal is to stay invested, and now it's time for the final day. Day 7. Make your first investment. Congratulations! You're no longer someone who says, "I'll invest someday." You have a plan. Today is not about investing thousands of dollars. It's about taking your first step. Review your budget. Review your emergency fund. Review your investment choice. Then invest an amount you're genuinely comfortable leaving invested for the long term. Remember, your first investment isn't supposed to make you rich overnight. Its real purpose is to help you build confidence. Once you've taken that first step, the next one becomes much easier. The 5 biggest mistakes beginners make before you go. Let me help you avoid 5 mistakes that trip up countless beginners. Mistake number 1, waiting for the perfect. If you spend years waiting for certainty, you may never get started. Mistake number 2, following social media hype. A trending stock isn't automatically a good investment. Always understand what you're investing in before committing your money. Mistake number 3, putting all your money into one company. Diversification can help reduce the impact of any single investment performing poorly. Mistake number 4, checking your portfolio every hour. Markets move every day. Long-term investors focus on years, not every minute. Mistake number 5, giving up after a market decline. Market downturns have happened throughout history. Many long-term investors stay focused on their plan instead of reacting emotionally to short-term volatility. Remember, every investment involves risk, and past performance doesn't guarantee future results. 7 days ago, investing probably felt confusing. Today, you understand the basics. You know how to prepare financially. You know how to choose an investment platform. You know why diversification matters. You know how automation can help you stay consistent. Most importantly, you know that building wealth isn't about finding a magic stock. It's about making smart decisions consistently over time. Don't worry about becoming an expert this week. Focus on becoming consistent this month. Your future self will thank you for the decision you make today. If this video helps simplify investing, make sure you subscribe because every week we break down personal finance and investing into simple, practical steps anyone can follow. Now I'd love to hear from you. Which day of this 7-day plan are you starting today? Leave your answer in the comments below. And remember, the best time to learn was yesterday. The next best time is today. Thanks for watching, and I'll see you in the next video.